Thank you, and I thank you for the introduction, and I really appreciate the opportunity to speak to you today. I am excited to be discussing stablecoins. This innovation has been unfairly treated as a pariah by some, but stablecoins are now an established and fast-growing part of the financial landscape. Putatively, stablecoins were originally intended to facilitate holding and trading cryptocurrency, but their proliferation has been aided by providing users with a stable store of value, a means of payment, and the ability to move capital quickly, irrespective of territorial borders. Demand for dollars continues to be strong, so it's no surprise that a more efficient means of accessing dollars has become increasingly popular. With the passage this year of the Genius Act, there is now a clear regulatory pathway in the United States for stablecoin issuers to broaden their reach and solidify stablecoins as a core part of the payment system. I believe economic research has some catching up to do. Economists meticulously study demand for dollar assets and consider how monetary policy may be affected, and the rapid growth of stablecoins affects the supply of loanable funds in the economy. I am encouraged that the Federal Reserve is taking steps to recognize the importance of stablecoins for the payment system. Greater transparency and rising adoption should help us consider their effect on monetary policy as well. Essentially, all stablecoins are denominated in dollars, and their success is at least partly due to the dollar's enduring status as the world's preferred currency. Stablecoins are also contributing to the dollar's dominance by allowing an ever-growing share of people around the globe to hold assets and conduct transactions in the most trusted currency. My thesis is that stablecoins are already increasing demand for U.S. Treasury bills and other dollar-denominated liquid assets by purchasers outside the United States, and that this demand will continue growing. All else equal, this new demand lowers borrowing costs for the U.S. government. However, as a central banker, my focus is on what I believe may be a substantial and long-term force putting downward pressure on a crucial guideline for monetary policy, known as R star. The neutral rate, or R star, is the policy interest rate that neither stimulates nor restricts economic activity when the economy is operating at its potential, once transitory effects of cyclical economic shocks have abated. There are several open questions with respect to the impact of stablecoins on U.S. monetary policy. How many assets will be managed by stablecoin issuers? Will the funds come from domestic or foreign sources? And where might substitution pull funds out of the banking system? What are the systemic risks related to runs on stablecoins? Since monetary policy must be forward-looking, my colleagues and I would be best served by exploring these topics now. In these remarks, I'll focus on the consequences for monetary policy if stablecoin growth follows industry expectations. In short, stablecoins may become a multi-trillion-dollar elephant in the room for central bankers. While I tend to view new regulations skeptically, I'm greatly encouraged by the Genius Act. This regulatory apparatus for stablecoins establishes a level of legitimacy and accountability congruent with holding traditional dollar assets. For the purposes of monetary policy, the most important aspect of the Genius Act is that it requires U.S. domiciled issuers to maintain reserves backed on at least a one-to-one basis in safe and liquid U.S. dollar-denominated assets. These reserves can be held in bank deposits, short-term treasuries, overnight repurchase agreements, or reverse repos backed by U.S. treasuries or government money market funds. Depending on the source of funds used to invest in stablecoins, it may constitute new loanable funds in the U.S. economy or the overall amount of money available for borrowing and lending. Even stablecoins outside the ambit of the Genius Act are likely to boost demand for treasuries and other dollar-denominated assets. Stablecoins that do not comply with the Genius Act can invest reserves in a much broader range of assets, but to be viewed as reliable stores of value, will likely end up still investing substantially in dollar securities with minimal credit risk. Sorry, there's a little reverb. The interquartile range of private sector estimates compiled by Federal Reserve staff roughly projects stablecoin uptake reaching between $1 trillion and $3 trillion by the end of the decade. For reference, the Fed grew its holdings of U.S. Treasury securities by just over $3 trillion during the latest round of quantitative easing in response to the COVID-19 pandemic. In total, under $7 trillion in Treasury bills are outstanding today. If these forecasts prove accurate, the magnitude of additional demand from stablecoins will be too large to ignore. The innovation of public blockchains means that stablecoins can trade freely on rails that anyone in the world can use. This advancement represents potentially transformational change for consumers and businesses outside the US, particularly those in emerging market economies or even advanced foreign economies, with burdensome restrictions on their payment systems. In many jurisdictions, low-friction payment rails are unavailable. Banking services to convert local currency or assets into dollars may be limited. Basic banking services themselves may be limited. And billions of people worldwide are subject to capital controls preventing convertibility and access to dollars. Globally, savers disproportionately favor dollar-denominated assets, and the ubiquity of capital controls is indicative of that revealed preference. For stablecoins to enter widespread use, there must be a bridge from local fiat currencies into stablecoins. One can imagine many possible bridges, often already in use for existing dollar vehicles. Remittances from immigrants working in the US might take the form of stablecoins. Exporters may receive portions of their payment in stablecoins, perhaps undeclared if domiciled in jurisdictions that prohibit stablecoin use. People might trade local currency for cryptocurrency, and then use that cryptocurrency to buy a stablecoin. Or they might trade physical cash or goods or services or other assets for stablecoins. Stablecoins merely make it easier to traverse some of these bridges and increase incentives for doing so, because once stablecoins are in circulation in an economy, they can circulate more freely and cheaply behind capital controls than traditional forms of dollar payments. These bridges will not be frictionless or have infinite capacity. For people who want to use dollars either as a store of value or as a means of payment but are unable to do so, stablecoins make it incrementally easier. Stablecoins will not instantly obliterate barriers to dollar use, but they will perforate those barriers. Reserve assets and currency provided by the US are global public goods, but some jurisdictions prohibit their citizens' enjoyment of them. Stablecoins might establish an easier means for the financially repressed to enjoy these global public goods and evade draconian restrictions on their finances. For individuals and businesses in many nations, especially those in which dollars are used for large purchases like homes, this also leapfrogs the challenges of high and unstable inflation or volatile exchange rates. To be fair, stablecoin growth may not live up to the forecasts I cited earlier. Potential limits on yield and reward arrangements could limit adoption, particularly in open economies. The presumption that the crypto industry will grow at the prodigious rates of recent years cannot be taken for granted. But even with these considerations, it seems likely to me that growth in stablecoin usage outside the US will continue at a high rate. One important distinction is that if domestically purchased stablecoins are financed with bank deposits, or foreign purchases are financed with existing dollar-denominated holdings, then it does not affect the amount of loanable funds in the financial system. Further, there's some risk that a flow of deposits out of the US banking system and into stablecoins could disintermediate banks, affecting the transmission of monetary policy and stunting the velocity of money. However, because Genius Act payment stablecoins do not offer yield and are not backed by federal deposit insurance, I see little prospect of funds broadly seeing the domestic banking system. The real opportunity in stablecoins is to satiate untapped foreign appetite for dollar assets from savers in jurisdictions where dollar access is limited. By contrast, users in the US and other advanced foreign economies, like the Eurozone, already freely access treasuries, dollars, and other instruments that offer yield and deposit insurance. I therefore expect most demand for stablecoins to come from locales unable to access dollar-denominated saving instruments, boosting demand for dollar assets and enforcing dollar dominance. The supply-demand balance for loanable funds determines the neutral rate, or what we call R star. As I discussed in a recent speech, I believe a range of different factors are putting downward pressure on R star and should be considered in formulating monetary policy. Some researchers have tried to estimate how much stablecoin growth might lower interest rates. In 2024, work by Marina Azzamonti and Vincenzo Quadrini estimated that if stablecoins are in widespread use and fully backed by US Treasuries, it could put as much as 40 basis points of downward pressure on interest rates. In estimating the effect of the projected growth of stablecoin issuance on demand for treasuries and other highly liquid dollar assets, it is helpful to make a comparison to what most researchers believe was a large factor during an era of declining interest rates that began around the turn of the millennium, what former Federal Reserve Chairman Ben Bernanke called the global savings glut. In measuring the global saving glut, Bernanke reported that the annual US current account deficit widened by 4 percentage points of US gross domestic product from 1996 to 2004. As I mentioned earlier, projections indicate between $1 and $3 trillion of growth in stablecoins over the next several years. Adoption depends on regulatory clarity, institutional integration, and factors emanating from outside the US. For instance, growth in emerging markets, foreign exchange fluctuations, foreign political stability, and so forth. An additional $2 trillion of foreign demand for dollar assets by the end of the decade would, all else equal, increase the current account deficit by roughly 1.2 percentage points of GDP over this period. The increase would represent about 30% of the size of the original global saving glut. More bullish stablecoin uptake forecasts on the order of $4 trillion would double the size of this effect, making it about 60% the size of the original global saving glut. These magnitudes would matter for monetary policy. Demand could obviously differ in domestic versus foreign adoption or miss these estimates. My goal is not to pinpoint the most accurate forecast, but to highlight the potential power of this channel. You can fill in your own numbers using the same method. My crystal ball is no clearer than others. Moreover, the asset mix purchased by the rest of the world 20 years ago differs from that purchased by stablecoin issuers. The effects of a lower neutral rate might therefore manifest in financial markets differently than they did last time. Even relatively conservative estimates of stablecoin growth imply an increase in the net supply of loanable funds in the economy that pushes down R star. If R star is lower, policy rates should also be lower than they would otherwise be to support a healthy economy. A failure of the central bank to cut rates in response to a reduction in R star is contractionary. If a global stablecoin glut looks like a global saving glut, some other consequences may be replicated too. For instance, a lower R star increases the odds that the zero lower bound binds in the future, limiting the ability of short-term interest rates to move down to provide accommodation, but not restraining their ability to move up to restrict activity. Markets may expect policy to spend more time at the zero lower bound because of that inability to provide accommodation and get away from zero. That may make the Fed funds rate more volatile to the upside with respect to other financial conditions, even as downside volatility remains muted by the zero lower bound, simulating elements of former Chairman Alan Greenspan's conundrum. Moreover, if a global stablecoin glut is driven by flows out of foreign currencies and into the US dollar, it will, all else equal, make the dollar stronger. Depending on the strength of this effect relative to other forces affecting the Fed's price stability and maximum employment mandates, that might be something that monetary policy responds to. Finally, incremental dollarization may reduce the benefits of floating exchange rates. Exchange rates often function as shock absorbers, adjusting rapidly to changes in relative conditions across countries so that nominal prices don't have to. If nominal prices are sticky and exchange rates are not, the cyclical distortions associated with those rigidities are less detrimental for the economy. Increased real price rigidity because exchange rates cannot adjust would intensify the volatility of global business cycles. And Fed policy will have a greater effect on foreign economic growth with greater dollarization, increasing business cycle synchronization. Whether this phenomenon would matter for the US and not just for countries that dollarize a portion of their economies remains speculative. America's capital markets are the world's deepest, helping to support economic growth, fund new ideas, and allocate capital efficiently. However, our financial infrastructure, not unlike our physical infrastructure, could use a reboot. Stablecoins may well lead the way on this, facilitating dollar holdings and payments domestically and abroad. While there has been extensive research on the topic since the advent of stablecoins a decade ago, the scope for rapid increases in issuance makes it now even more imperative to consider what widespread adoption of stablecoins may mean for monetary policy, both in the United States and abroad. Thank you. Okay. What do you want me? I'll grab my water. Sure.
Good afternoon. Thank you for your speech. I just want to emphasize that is this the first speech that you've given on stablecoins?
This is the first crypto speech I've given at all, and as you can tell, I'm.
Hello. Everybody, wake up! This just happened.
Thanks. And as you can tell, I'm not an expert on the technologies of crypto, but I do think that the innovations that are occurring clearly matter for monetary policy, and they clearly matter for a lot that the Federal Reserve is doing. And so I think it's important for us to start thinking about those and thinking about the ways that they affect the rest of our business.
That's awesome. I want to just just put you on the continuum of the Federal Reserve and just put you and place you in this moment in time. The Federal Reserve was created in 1913. You sit on on the continuum of a long list of Fed governors. That Federal Reserve in 1913 was created by the Federal Reserve Act. signed into law by President Woodrow Wilson, partly to address financial panics like that in previously 1907. So essentially, you're a central bank that serves being the bank of banks. And just want to talk about, when we chart the future, we talk about the future, it's always good to look back at the past because history echoes, it has lessons and learnings, things that we can unlearn. And as we look at the modern mandate of the Federal Reserve and the new challenges presented by intelligent technology, the rise of new asset classes, and the speed of connectivity that makes us both stronger and vulnerable at times. Governor Miran, I want to just start out by having you just give us a sense of how vital the role of the Federal Reserve is now in this modern economy and in this moment where we have disruptive and redefining innovation.
Yeah, so that's a great question, and the Fed has evolved enormously since 1913, and so when it was created, it was mostly about financial stability, as you're pointing out, runs in the banking system. Over time, the Fed has gained mandates for keeping inflation in control. The Congress assigned us to a price stability mandate. It's also gained mandates for managing the business cycle. The Congress assigned us a mandate to maintain maximum employment. And so we set monetary policy in accordance with those mandates that the Congress gave us, but we also do an enormous amount in the payment system and in the financial plumbing that underpins payments that go between people. And anytime you're sending a payment to somebody, whether it's a check or a credit card or a bank wire or whatever it is, at some level the Fed is involved in that. And crypto and stablecoins are the latest in a long line of really creative innovations in payments that have enabled commerce and enabled prosperity and enabled increasing increasing economic activity. And so I think that it's really exciting how the Fed is coming to grapple with these as the technologies become more and more widespread in use. And I think there's a lot of exciting stuff ahead of us.
And you mentioned the dual mandate, that of promoting maximum employment and stable prices, stable prices, stable coin. I mean, talk about how you come to your view of stablecoin in its presence in terms of our economy and a part of an innovation of future of finance and future of money. How stable, when you're looking at your data and your analysis, can you talk about stablecoin from your perspective? What's your view on how it can either be part of a growth moment, or what are some things that we need to look out for in the process?
Sure. So, like I said in the speech, I'm very encouraged by the Genius Act and the regulatory framework that's being set out for stablecoins, because they create an environment in which stablecoins are backed by assets that will allow them to hold expectations that the buck won't be broken. The concern with money market funds or any other type of asset is always what are the assets, what are the assets that backing them, and is your money going to be there? Will the buck be broken? And there's regulations throughout the entire financial system to ensure that that doesn't happen. And what the Genius Act does is extend that coverage to sets of stablecoins that allow faith in stablecoins that the money is as good as it is in other forms of holdings that then will allow them to enter into broader use. And I think that you're seeing that. I think that you're seeing the growth in the assets. That we have been seeing the growth in the assets. And so I think, as I said before, that it has implications for all sorts of things that we do at the Fed, and I think it's important for us to start thinking about those subjects now.
And I in your speech, you talk about how, the Genius Act has led to legitimacy and accountability and clarity with respect to stablecoin, issuers, and in the process. Would love to understand from you, do you think that as it's been enacted and you see the adoption and thriving growth in this space, is it living up to its name? Is it timely? Is it overdue in terms of the act? We're looking for more legislation to come through on market structure, but in terms of Genius Act, in terms of it's here, how do you think it's doing?
Yeah, so I think, as I said before, I think it's important that it seems like it's important for for financial stability. But the rest of it, is not up to the Federal Reserve to. It's not up to the Federal Reserve to do the legislation. It's not up to the Federal Reserve to do the regulations and the rule writing. Right? We oversee payments and we oversee monetary policy. And so I think it's important for us to respond to the developments, but it's not really up to us to be the ones that are putting in place that regulatory framework. Yeah.
Great. So I want to just also move through to transition and connect the dots between monetary policy and economic shifts. Just talk about the role of the Fed in monetary policy in enabling a thriving innovation economy. We have a lot of founders here who are focused on innovating, who are disrupting, who are pushing boundaries and moving forward. I'd like to kind of get your sense of how you see these converging, these pieces of you're applying policy to this innovation.
Yeah, so we all know that innovation drives long-run prosperity, right? When you look at the very long run of economic growth, it gets better because of innovation. It gets better because we're coming up with new technologies, and it gets better because we're coming up with better ways to use our inputs to production and to organize the economy better. It's really important that the Fed adhere to its mandates the Congress gave it, stable prices and maximum employment. And if we do that, what will happen is that we end up reducing the volatility of the business cycle, because the volatility of the business cycle can really interfere with the innovative process, right? You want to create an environment in which the economy is relatively stable, and that allows innovators to do what they do and not worry about large macroeconomic downturns that are going to be the type of thing that will that will nip things in the bud that could theoretically be huge innovation. So the best thing that the Fed can do is to stick to its mandates, stick to price stability, stick to maximum employment, and if we do a good job with that, then the business cycle will not get in the way of what ordinary people in the economy are trying to do with innovating and opening businesses.
Great. For Web3 and AI are driving the next industrial revolution. History shows that major innovations led to sustained productivity booms. In your view, what underpins a genuine economic revolution when it comes to technology? What core changes or metrics would you consider trends like Web3 and AI as part of a new industrial revolution?
So that question's a little above my head. I mean, I'm just an economist. I'm not a technologist. But look, we as economists, we look at what we would call total factor productivity, which means our firms, our businesses, using the inputs they have more efficiently than they were in the past. And what technology allows you to do is it allows you to do more with less, right? And that's what we think of as productivity growth. That's what we think of as technological innovation that drives the economy forward. And that's what we look for in the data. And what we've seen in the data in the recent past is an improvement in total factor productivity growth. But it's not an improvement to levels that would be sort of historically anomalously high yet. It's an improvement over where things were. However, what I would like to see in the future would be even more TFP growth, and I implore the folks in this room to keep on innovating.
Indulge me with questions that are maybe overhead, but they're not over your head. You're mastering these. You're great. So for a crypto question, crypto's on the main stage. Bitcoin, ETH, stablecoin are affecting markets and are widely tracked indicators. 86% of institutional investors now have exposure or planned allocations to crypto in 2025, with nearly 59% committing over 5% of their portfolios to the asset class, according to a survey conducted by Coinbase and EY. What is your opinion on crypto, its growing adoption by institutions, and its staying power as an asset class?
So, as I said, I see stablecoins as an area of enormous growth, both that have grown enormously recently and is also of potentially large growth in the future. And based on the surveys that I've seen and the forecasts that I've seen, it's a force to be reckoned with, absolutely. The rest of it, as I said before, I'm not going to hold myself out as somebody who's able to tell you exactly how all of these innovations are going to unfold. So I don't know, sort of who's going to win which horse race, or exactly which are the technologies that are going to enable transformational change. However, I do think there's a lot of innovation happening, and I think that innovation is already starting to have economic consequences of the type that matter for the Fed and of the type that matter for monetary policy. So I will be paying more attention to these things as the future. There's a number of unanswered questions that we have to start paying attention to, and we also have to start paying attention to how these things work themselves into the payment system. And I think there's good progress there.
That's encouraging. For the stablecoin market cap right now the stablecoin market cap is over $300 billion. Last year, the total transaction volume of stablecoins exceeded 27 trillion, which is more than the combined transaction volume of Visa and MasterCard. I believe as of now, the transaction volume is around 47 trillion. So I want to just say, just a report by the Citibank Institute this summer estimated that by 2030, stablecoin issuers will hold a collective 1.3 trillion of U.S. Treasuries. I think in your report you may say between 1 and 3 trillion. More than 1.1 trillion currently held by a single largest shareholder, Japan. Largest holder, Japan. What role will stablecoin play in future monetary policy considerations as they scale as an asset class?
Yeah, so the 1 to 3 number that I quoted in the speech was really the 25th percentile and the 75th percentile of a range. We basically, the staff at the Fed took a range of private sector estimates, all the ones that they thought came from credible sources, and I basically just looked at what we call the interquartile range, the 25th, 75th percentile, right? You could also look at the median, whatever you want to do. But that was for overall flows into U.S. assets, right? So Treasury securities, of course, would be the largest category, but that was for overall flow. So and when you think about what matters for monetary policy, it's flows overall into U.S. assets that would matter for the neutral rate. And so the point that I was trying to make is that the more money flows into U.S. dollar assets from other that was originally denominated in other currencies or outside of the U.S. system, or even if it was U.S. dollars that were physical cash that were stuffed in a mattress, and then suddenly it becomes loanable into the economy. What matters is the supply-demand balance of loanable funds. It's savings that are available to invest relative to investments that are going to occur. You're going to invest in a new technology, or build a bridge, or a school, or whatever it is, or a house. Whatever you're investing in, what matters is the supply-demand balance between savings and investment. And if you have an exogenous increase in the amount of savings that are available because stable coins are allowing flows into investable assets that otherwise wouldn't be getting funding, that has implications for monetary policy. And the point that I was trying to make is that the more that happens, the more that we lower the so-called neutral rate in the economy. And the more the neutral rate goes down, the more the Fed has to cut rates just to keep policy where it was before. If the neutral rate goes down and you don't cut rates in response to that, that's effectively contractionary and will drag the economy down. And of course, that's something that we don't want to do. So the more stablecoins actually grow and the more stablecoins pull in savings into the US economy from places they might not otherwise be, either because they were physical cash stuffed into a mattress or because there's money flowing in from other forms of deposits that are not in the US financial system, the more that happens, the lower interest rates will have to go in the United States as a result.
Can we talk about U.S. dollar dominance? So are stable coins, in your opinion, an opportunity or a threat to U.S. dollar dominance as in that statement?
Well, I think ultimately, a lot of that question has to be directed to the Treasury Department. But from my perspective, I think that flows into the dollar as a result of stable coins. Because if you buy a stable coin and it's backed by dollar assets, including Treasury securities and other types of dollar assets, I think that enforces the international role of the dollar, which enforces dollar dominance in a lot of the system that we have. But that's if the flows materialize and if the system expands.
Thank you. So just my final question. On the future of central banking, as digital currencies and token economies evolve, how should we think about the future of the role of the Fed? What is on your wish list that would make the Fed a more effective body to handle these modern innovations?
So I think that the Fed is doing a good job starting to incorporate a lot of these technologies, and I think that my colleague Governor Waller is really leading the charge on payments and integrating some of these things into the payments rail. And so I think for the Fed to be doing a good job on the developments in technology, we need to stay abreast of the new technologies and what they mean for payments, and we need to think about how to integrate them into our existing systems. And I think that folks are hard at work at that at the Fed.
Right.
Yeah.
Well, we have a room full of innovators here that I'm sure are happy to talk about their products and their services and all of their innovations that they're doing, so you can stay abreast with the room that we're in. And I want to thank you for this conversation, for your speech, and for making a moment in terms of talking about stablecoins to this BCVC Summit community. Can we all thank Governor Miran for his comments and remarks? Thank you.
Thank you for having me. Thank you for having me.